Welcome, welcome, welcome. It's the start of a new trading week here on Tasty Live. This is First Call. I'm your host, Chris Vecchio. He's Ilya Spivak. We're sitting in for Tom, for Victor here tonight. Pete Molmat will be joining us shortly. If you're joining us on YouTube, make sure you come over to the platform, come over to the website, tastylive.com, see what we're all about. Obviously, if you know about those, join us in the chat, see what you're going to be thinking about this trading week. Ilya and I certainly will be sharing our feelings here. Ilya, how was your weekend?
Nice and relaxing after last week's fireworks. Just puttering around San Francisco. The weather has been great. Food has been tasty, and the sunshine has been nice. So just roaming around.
That sounds ideal. No, we're still dealing with this impromptu kitchen renovation, which is a delight.
Oh, fun times.
To have been thrust into. But hey, we had the exterminator here, and there's no mice in the house, which is good to know. And we're going to win the battle against these stink bugs. That they will.
One victory at a time.
They will lose. But it was a weekend, Ilya, where, quite frankly, I was glued to my phone, seeing what kind of news flow we would see out of the administration. And that is the focal point, I guess, here moving forward, because from my standing, right, you're a bit more macro than perhaps the people who would normally be hosting this. But we're now in the Fed's communication blackout window. And to that end, it's a week where we won't hear from Fed Chair Powell or anyone else that really speaks from that purview. It becomes a week where we focus on data. And if there were any, it would be earnings. Not that many, of course. We're on the other side of earnings season here. What do you think about this upcoming week? I mean, what's your sense of the state of risk appetite right now? We've seen sentiment indicators hit lows, new lows, all-time lows, depending upon where you look.
I wouldn't be surprised if there's a little bit of a consolidative kind of pause in the most vigorous sell-off tendency here going into the week, because we've got CPI in the middle of the week, and that's obviously a big part of this story. Now that we've seemingly decided collectively that what we're afraid of is some sort of an economic slowdown, some sort of a, dare I say, recession kind of a situation, the market is obviously going to be looking very closely to what these CPI numbers do. I don't think they got a whole lot of encouragement from Jay Powell on Friday. He was very much not in a hurry to do any cutting. And so I think how these CPI numbers come out will be very, very interesting. And maybe the markets are going to reserve judgment until that number comes out. So you might see, I think, a little bit of consolidation here before CPI comes out, just out of deference to the event risk. And then we'll see. I'm wondering if a weak CPI number actually enthuses everybody, because I suspect not. I suspect a low CPI number just becomes weaker growth with the Fed resistant. And so you get another risk-off push if the number misses.
We do have the opening prints coming across the board here now that the futures market is open here for the trading week, 6 Eastern here in New York. S&P down by 0.6% right out of the gate. NASDAQ off by 0.64%. Russell, Dow Jones, similar situation. Crypto feeling some pain here. Bitcoin futures down by 5.67%, as well as we get some of the news and updates around the administration's strategic crypto reserve. Ilya, we get the contours of that announcement. It's more of a strategic Bitcoin reserve per se, and the government is not necessarily going to be taxing and spending dollars, issuing new debt to add to that reserve. They're going to do what you and I discussed last week on Overtime. They're going to take the holdings that they have in the various wallets that they own. They'll consolidate it in one place. And instead of selling off holdings that they currently have and that they have been doing, when they seizure these from various criminals and whatnot, the U.S. government will just hold on to the Bitcoin moving forward. So no new capital necessarily being allocated into the space, at least initially. And we see here coming outside of the weekend, markets are a little bit, I would say, disillusioned, or at least not so happy with that news. So Bitcoin off by 5.83. Ethereum off 6.28. When you heard the first announcement about this and we saw the rally coming out of last week, without the details, didn't it kind of seem silly that at a time when we're talking about reducing spending and a balanced budget, all of a sudden we'd be issuing new debt or having some sort of sovereign wealth reserve predicated around Bitcoin? At least this version of it makes technical sense.
Yeah, I mean, this version of it is basically a non-event. I mean, if anything, it says that the government is not going to be raising money, since it seems to be in a raising money kind of mindset with all of these budget cuts and a desire for efficiency, a desire for reduced spending, a desire for reduced debt. It seems like one option might have been government owns all this Bitcoin, we're near the highs, sell it and raise a bunch of money. But we're getting the signal here, and perhaps it's not surprising given this administration's view of Bitcoin more generally and crypto more generally. It's a more crypto favorable administration, that they're not going to do that. They're basically not going to become a reason that this market goes down. They're not going to be a reason that this market goes up either. And that's probably a good thing. It's certainly a strange mix of incentives, or would have been a strange mix of incentives, if we said we're not going to spend taxpayer money on anything but buying Bitcoin. That would be odd. So this makes more sense, as it were.
Bitcoin vol really not here either. 17.8 IVR. I have a longer term view that if we can get back into the highs from last March, closer to 72K, 73K, and the 200-day moving average right now in the BTC continuous contract is closer to 76,980. That gives you a zone where overshoot, perhaps looking long deltas, and would also represent the finished move of a double top here in Bitcoin that we've seen carve out. At least the equidistant measured move is in that area as well, which, Ilya, I suppose is a good time as ever to do a little bit of a plug. Should we call it a plug here for all the new Tasty crypto?
Plug.
Can we call it a plug? We're allowed to call it a plug. We have new Tasty offerings or new crypto offerings here on the platform. Cardano, Chainlink, Avalanche, AVIV, or AV, and Shiba Inu. There have been various releases, of course, over the past week. So be sure to check it out on Tasty Crypto. And we're going to be having Ryan Grace join us on Overtime moving forward, perhaps every other week as a fill-in for Radigan. So we're going to try to have his perspective, between you and me, Elia, a little bit more informed crypto perspective than just two risk junkies. This guy actually built a business around it.
Certainly better than my perspective as the perennial party pooper.
While we see equities take a little bit of a dip here at the start of this week, we are seeing that bonds here are bouncing back after Friday's move to the downside. Of course, non-farm payrolls were on Friday, coming in at 151K versus about 160 expected. But it was above the consensus forecast, at least the whisper number ahead of time, which was sitting closer to 125K. ADP, of course, was a little bit weaker, and there were concerns it could be a flat or negative number. So I suppose that's the good news. It wasn't a negative number.
Yeah.
But the report, as you and I were talking about on Futures Power Hour, it wasn't really a great one.
No.
So we have CPI this week. We don't have any Fed speakers. We're in the aftermath of now non-farm payrolls. What do you think about ZB here, bonds at 117?
I like it. I like that we're trying to undo that last red candle with this gap. I mean, if you take a look, I love me a nice horizontal level. If you drop that gray line that you have there down to the initial swing high from that top there, not the spike high, but the initial high right there. Yeah, you get a nice little zone. And as ever, right, support and resistance is never just a line. It's give or take a fuzzy area usually. And
Edwards and McGee, by the way, to just point that out, technical in like the Bible of technical analysis, Edwards and McGee, you don't have a break of an area unless it's a 3% move on the other side of it in terms of stock prices. Now, obviously, 3% in ZB is a very big move, but that's why if we're talking about going into a zone, depending upon liquidity conditions, the news flow that day, the time of day you're reaching that zone, like you're going to overshoot or undershoot. So more art than science. Yeah. Go ahead.
Absolutely. And even if you go to the Bible of Bibles from John Murphy, who's very kind of old school with it, even he will tell you, give it a little bit of space around levels. You can't expect it to be just a line through the chart at a given level. So it looks like we had a pullback, and it looks like we're retesting former resistance as support. It looks like we're finding it where we'd expect to find it. And so I'm just looking for this to give way to some sort of more concrete reversal to add. I mean, I'm already long. I'm long through a TLT call vertical. I've been long for a little bit here. I've been holding rather this vertical for about almost 2 weeks now, 12 days. So I'm at about a scratch, a little bit better. I got long where the break of that high that we're retesting now initially occurred. And so if we got back down there and found some sort of a level to hold, I'd be looking to add. I like bonds long here.
Yeah, I'm still holding the long calls in ZN. I'm still short the put spread in ZB. Obviously, if you are, those might be big depending upon how you're trading. And if you're new to bonds, certainly perhaps stick to TLT. ZN is a more approachable product than ZB. It's about half the contract size, half the tick value, half the overnight margin requirement. So it is a good place for people to ultimately start if they're dipping their toes into the futures market. But it is a CPI week, right? Like Wednesday, that becomes the big event. And given the fact that there are growth scares here, this is not exactly the same context of if inflation's a little bit softer on the way down, that means the Fed can cut sooner and declare victory sooner. It kind of feels like if inflation misses, then hold on, the growth concerns are real. But there's also the risk that, like, if it's really warm, then we have stagflation because the growth impulse is negative. Is CPI the thing that we should be paying attention to? Because it feels like so many other CPI releases recently have kind of come and gone with nothing.
I think it's going to be very important to watch here, because I think what you end up with from about mid-February is a different dynamic than we had before. If you look at what's going on in Fed funds futures, before you'd get slightly hotter number, slightly cooler number, and a rate cut would get pushed around. It would be priced into 2025, then move to 2026 if it was a hotter number. If it was a cooler number, it would move again from 2026 back to 2025. And the overall outlook through the sort of reasonable forecasting window out to the end of next year would be relatively unchanged. Since about mid-February, as these growth concerns have really started to bite, the situation has meaningfully changed. We've seen significant dovish readjustment for both years, this year and next year. So we're looking at 69 basis points now for 2025 and a full rate cut, 24 basis points, almost a full rate cut, negligible difference, baked in for next year. So it looks like we have what the Fed would be telling you. Back in December, they said 100 basis points over these 2 years. We're essentially there now, but the markets are more urgent. 3 of those cuts are in this current year and only 1 next year. So the markets want of the Fed more action sooner. And the Fed, listening to Jay Powell on Friday, is not of the same mind. So you get a CPI number here that's a little bit softer. That only amplifies for markets. We have a growth concern. The Fed is dragging its feet. Put more rate cuts into 2026. That probably means higher bonds, probably means a weaker dollar as those yield differentials move against it. Just take a look at the euro. It would not take even a day's break after kind of slowing on Thursday. It's continuing to power ahead. That tells me this is a bad news is bad news kind of an environment here for markets and for the dollar and for rates on U.S. economic data.
Well, we should bring in Pete Momat here to talk about that. He's our big FX guy. He brings in the FX perspective every single week here on First Call.
Yes.
Matt, Laura, let's bring in Pete Momat to talk the state of these markets.
Gentlemen, how are you? It's great to see you this afternoon. Chris, you're living the homeowner's dream, huh? Every single day. Yeah, I know. I was digging a hole in my backyard this morning, too, replacing a sump pump. It never ends.
It's always something. It never
ends. It's the glory, the American dream, Pete, owning your own home.
Yeah, we're kind of in Chicago, too. It's nice. We actually had a really nice weekend. It's warming up a little bit. So it's we're in that March period where they tease you with 2 nice days, and you think,
right.
And all of a sudden, I'm thinking, do I pull the driveway markers out? Do I start? And it's like, no, I'm just putting a curse on myself for more snow. But aside of a nice weekend, we're setting up this week to be really interesting. What you guys pointed out, the pounding in crypto over the weekend was relentless, and we're seeing U.S. equities follow through on that right now. SPU's releasing, NASDAQ releasing. I want to get you guys' take because we're really seeing some divergences. That Euro move, Ilya, you're spot on. 4.5% in 5 trading days was a huge move.
Huge move.
So 400 pips to the upside. We had a decent pullback from the highs again, from that 108.70 level in spot, 108.95 in futures. You had a 70-point pullback, 80-point pullback. That's all this market gave you. And no matter what Mr. Powell said, because remember, we had an equities market that got slammed hard on Friday and then had that short covering rally, and they attributed it to Powell soothing markets or whatever it was. We just had a little taken off the table. But you couldn't get that Euro bid out of the market. And it seems like they've got the shorts in a bit of a box right now.
It seems like it. I mean, the situation in European rates has become a huge thing. I mean, European rates are absolutely surging. So when you look at what's going on with the yield differentials, Euro USD has been following really, really closely, going back to, let's call it, mid-2021 to that the 2-year U.S.-Germany spread. Just relative monetary policy. What's the ECB doing relative to what the Fed is doing? And of course, no surprise, from September through December through even middle of January, the story was the Fed got too dovish in September. We're going to drive up the dollar. We're going to drive up yields. It was happening across the entire market. So the yield differentials moved to the dollar's favor. Well, now with maybe a growth scare in the U.S., the pricing for the Fed getting a little bit more dovish, and rates absolutely surging in Europe around this military build-out conversation. A lot of people, by the way, Chris, have picked up on that thing I was saying last week. I think I should be getting residuals. I was saying that if Japan said that they woke up a sleeping giant in attacking the U.S., Russia may have woken up a sleeping giant in Europe. Europe wasn't thinking about weapons for 40 years. I think everybody's about to find out what European history was all about.
European history works out well.
Those borders are blood-soaked to the core.
When Turkey remilitarizes, have we not seen this before?
It's like, you'd like the UK and Germany to get armed to the teeth? Okay. This has worked out great before. So huge military build-out story. I mean, the UK, Germany, and France are of one mind, and they want to get armed to the tunes of maybe $1 trillion or €1 trillion altogether spent. Not surprisingly, that's going to be a boost to growth for the next, let's call it, few years. It's going to be a boost to inflation. So European bond markets are very much responding. Those yield differentials are soaring in the euro's favor.
Right. And you see that play through the DAX, German stock market at lifetime highs. Where do we go in the U.S.? Okay, FXE, I've traded in the past. There's not much in it anymore. On the ETF side, what are some of the European ETFs that we haven't really looked at in a long time that we can take a look at?
Easy. I mean, if you're, there's two camps, right? If I'm bullish on European equities, do I want to have exposure to them in the euro or not in the euro, right? Because if I'm long European equities, but the euro is going down in value, then it doesn't matter that those stock prices went up. When I convert them back to dollars, I'm going to take a currency conversion hit. So the unhedged European ETF right now, if you think the euro is going down and European equities are going up, you're looking at something like EZU, which, as we can tell from this weekly chart, we just decisively punched through the all-time highs. We got there in May last year, right? And we fell off through them. We got there again in September. We fell off again below them. It looked like false breakouts. This time, it's very clear. This is something real, something different. But this is a material change, Pete. I mean, been doing this for just as long as Lee and I have, and then some. And I point that out because how long has the idea that Europe is basically just slowly in a state of demise? They're never going to spend money. It's a crisis. It's a constant slow crisis. This isn't about face. This is a different world now.
It's a different world.
Assuming it all happens.
To have the Chancellor of Germany, the Prime Minister of the UK, and the President of France hold hands together and say,
you're saying something. Yeah,
hold hands.
The most troubling visual about being short euros at this point.
Just hold hands together and go, we need to spend €1 trillion on guns. You go, whoa, this is a whole other thing. Another ETF here, by the way, FEZ, which is a little bit cheaper and just is going to be a tracker of the Euro Stocks 50.
There you go.
The vols here are a little bit lower, which makes the instrument a little bit cheaper to trade than EZU. A little bit cleaner.
On the call side, if you're selling vol.
Yeah, on the call side. Not quite as liquid, but still very liquid. And so a secondary option if EZU is a little bit expensive for folks.
I always trade German concrete producers, Pete, but I'm not, I'm like trying to like stick with what I know, and I don't know anything about the German concrete industry it's going to be like trading a meme coin.
So FXI has had a tremendous run, a little bit of a pullbacks. Yes. They seem like it opened so strong every day and then just kind of folds, but unlike the European ETFs we just ran through that are blasted through new highs, FXI, we've been at much higher levels previously, but what do you think? Is it really, this is the one time where the shine's off the U.S.? Everything
not
is
China.
Well, that's my question, because this is, you look at some of the big Chinese stocks. I think Tom trades a lot of Baidu and JD, which have had huge runs too. Is this the time where, FXI has been on a tear, all these have been, but they're still relatively lowest quartile of their range for going back when you look at a period of time. In terms of stuff that has legs, are we going to see a rotation into this, or is this going to be the caveated rotation around tariffs in China?
So my theory, and Chris, I promise I won't be long-winded, but I did a whole macro money on this last week. All of the names in FXI are listed in Hong Kong. All of the names in ASHR are listed on the mainland. If you look at ASHR, the tracker for the CSI 300, it's going nowhere. But if you look at the Hong Kong listed names, they're following the Hang Seng Index, which is surging. So last week I went on a mission to figure out what was going on. I looked at the Stock Connect flows from mainland into Hong Kong. It's only going one way. Nobody is rushing to invest on the mainland through Hong Kong. Northbound flows are still very anemic. This looks more like Chinese money running away from a slowdown, not like international confidence coming back. So for me, this is not a positive China story.
Okay, so back in the U.S., what are we looking at? NVIDIA beat up. We had a decent bounce up Friday. Some of the big, Tesla seems as good as it was, is as bad as it is right now. Is there value to be had somewhere among some of these stocks that have taken such a beating just on the, Chris, we were talking a little bit about this and from a technical standpoint, we were talking about moving away from those moving averages, and we're not going to take a deep dive into technical studies, but you're having a little bit of that mean reversion moment, aren't you?
It looked like we were going to, and you can clearly see some people trying to be dip buyers down here, but outside of Friday's close, the action intraday has been so ugly. The volatility has just been sticking around and then grinding to the upside. And like here in Tesla, we did get the bounce off the 200-day initially when we first touched it at the end of the prior week going into March. And then we lost it, and we lost the uptrend off of Tesla's lows in April and August, again, pre-election in October. So this is just an ugly looking chart. And that's to say nothing about anything to do with the cultural significance of Tesla and its CEO right now in the political zeitgeist, right? So it's an 88 IVR. It looks like it's catching a falling knife. We don't need to do a deep technical study, but in terms of just trying to find a place to pivot, I would just point out that since the 20th of February, as is the case with many of these indexes like S&P and NASDAQ, we haven't put in a close below the 1-week moving average. And we're not doing that here in Tesla either. So if I wanted to sell some puts down here, I'd want to see some sign that the momentum's broken. It may not work out like it did in mid-February, where if you sold the put here on the 13th, you only had a few days where it was looking good, and then you had to make a decision about whether or not to stick with it. But that would be the window of opportunity I would look for. Because there aren't many catalysts this week, particularly none that could really scare people about growth, Ilya, with that calendar. There's no Fed speakers, so maybe this is a week where shorts, decide to take some off the table. And I guess in the true Sosnofian fashion, bulls are getting the open that they want here, Pete. If you want the market to move up this week, you're going to want to see a gap down on the other side of the weekend first. So maybe this is Asia reacting, and then ultimately we start to find our footing. With a CPI print that could be just on the nose or a touch softer, Ilya.
Yeah. I mean, I'm curious, Pete, what you think about gold here. We're at about 90 and just stuck at 90 on the gold silver ratio. Silver's moving around a little bit, but gold, it had that attempted breakout. It came right back to where the breakout occurred, to the cent, and now has just gone to sleep. What's going on?
I was looking at that because they're copper got above 480 and just on a tear. We're back down under 470. The base metals are really, again, following through on the growth story. You're seeing copper really having a hard time. Gold is, you're right, it stages these rallies, kind of gets close to that $3,000 level, falls off. But we've tried 2 very short attempts under 2,900. And they haven't lasted more than a day. So I'm a little bit caught here, as I honestly think if people are pulling stuff off, you're seeing crypto get sold, U.S. equities pulled off, the dollar getting unloaded, so to speak. At what point does gold give back some ground? Because we are really still holding on the bulk of those last year's. I mean, there were huge gains. 24.5% last year. And we're still holding on to the bulk of that, plus what we put on this year. So
that's performing asset class.
The strength. Yeah.
Yeah. Well, I think the gold story, and this is actually really interesting talking about growth. I was tweeting about this the other night. The Atlanta Fed had to put out a blog post trying to explain away why their growth estimate is so weak. And they said, listen, like as part of our exports figures, people have been importing so much gold that if you were to take gold imports out of the net exports, the GDP tracker would go from minus 2.3% to plus 0.4%, right? So maybe, all this happens in December, January, February, rolling basis as well. There's clearly some reason why people are hoarding gold here in the United States while we're importing so much gold. Maybe they're actually getting ready for the Fort Knox audit. But
I was praying you wouldn't go to the Fort Knox audit. You had to go there, Chris.
Hit your bingo card.
God. Put the Kool-Aid down. Put the Kool-Aid down.
Of the many stupid stories out there, this one is near the top of the pan.
Please. The Wi-Fi in your bunker is exceptional. It really is, man. I gotta hand it to you.
That's that good
Whatever
thing for. That's that Reynolds wrap heavy duty.
Yeah.
Listen, Hey, Ilya's doing the Tom thing here. I'm playing the Victor role. Okay, Pete? Like we all have a job here to do tonight, guys. So like there's a big growth issue going on in the tracking data. Some of it has to do with the gold imports. Clearly the demand is there. My issue is that when we were rallying here, guys, in gold, vol was creeping up from the start of 2025. We come into 2025 like the IVRs are in the low 40s. Yeah. Here at the middle of March, middle of February, you're looking into the 70s again. Yeah. And then that peak in vol comes on February 11th, and as vol gets sucked out, you see the arrow here in the lower panel. That's when gold fails to continue to rally. And what's happening here to gold right now at the start of the week? Volatility is continuing to come in. So not exactly the ideal conditions to continue to rally. I'm still long my gold call spread, 29.50 short 3K. I still have long deltas in silver and in copper and in bonds. Pete, Ilya and I have plenty of time to talk. We're talking on Futures Power Hour tomorrow. We're going to be on overtime together. So I don't really care what he has to say. And he doesn't care what I have to say. But the people want to hear from you. So tell us, what do you think about the market this week after what was the worst week in equities in 2025?
Well, I think you made a great point, Chris, is, I think we've had some weak attempts at a rally, and it's been met with substantial selling. We're seeing it now early. I think there is a little bit of, if we have any chance to find a little bit of a footing, I think we need to do down first, like we're doing right now, and then see going into some of whether it's the PPI number or CPI number. Maybe we build a little bit of footing off of that, rather than having another weak rally that is, I think, just another opportunity to sell. So I think I'm still looking at where we are. We're slightly below 200-day moving averages in SPOOs and NASDAQ. I think we work our way a little bit lower and then maybe find midweek some strength in the market here. It's really going to be interesting, this currency story, because we're really seeing it get not dollar, but currency specific, as you said, Ilya. Euro is still, we opened a little bit lower in euro. It's still 108.5. While Canada cannot find a bid no matter what. It's still just got the weight sitting on it. Yes, it's off its lows, but remember, 148 was a spike high. We're still sitting at multi-decade highs in Canada. Aussie and Kiwi not faring much better. So it's becoming very currency specific. So it'll be interesting to see if U.S. equities weaken. Does euro continue with the bid tone? And I'm having a tough time finding trades and rates. So I'm actually looking for, if tonight we do get a rally, I'd be interested in possibly selling that. But I think your point, Chris, in U.S. equities, whether you're picking some of the low-hanging fruit that's cheap now, you're going to have to see it trade a little bit cheaper. Otherwise, I haven't seen anything in tape action to tell me that it's worth picking a bottom here or trying to catch this right now. So I think you got to be a little bit selective on your timing. I'd wait for better levels to buy. I'd still rather be a seller in SPOOs and NASDAQ. And I don't have the Russell piece on now. And that's the one that doesn't really challenges me, because with bonds up at 117, the Russell piece is not working. It's not
right.
The lower rates are not helping. So I don't put it on and then, this should come together because the bonds are telling me it should. The trade's just not working right now. So I'm taking a beat off of that. And I think we're going to see some really interesting FX markets this week. And it'll really challenge, because the pace of movement in this euro has trapped a lot of people who are short, long-term euro shorts, dollar longs, and there hasn't been an exit piece. So this is a little bit of the pain trade. Can we see 110, 111? You guys have traded these currencies long enough to know once it gets to a new range, that elasticity that kicks in can be pretty impressive before it turns.
Right. Yeah. Sticks around for a little while there. Ilya, we are going to be back tomorrow morning here on Tasty Live. Of course, Tom, Tony, Vanetta will kick things off 7 Central as they typically do. You and I, of course, will be back for Futures Power Hour, 1 p.m. Eastern, and then overtime, 4 p.m. Eastern. So the good people will hear more of our thoughts. Pay attention to the Tokyo Open tonight. Looks like it's going to be a fun one here. Futures are down across the board. Equities red, bonds green. Risk-off day perhaps coming down the pipeline. But hey, that's it. We're done with First Call. So for Pete Momet in Chicago, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Good luck trading tonight. We'll catch everyone bright and early. Up next, we have a new Rising Stars piece. You're going to want to check it out. Stick around here on Tasty Live.
Derek started trading early 2000s.
Couldn't have done it any worse.
How much of your account did you lose?
Probably about 60, 70%.
The story today is different, and the number is 8 figures, over $10 million. How long did it take you before you started to make some money?
I had to get a job.
What happened?
25 grand.